So I've been brokering now for a year and I love it. Love it. I don't think I'll go back to a retail environment
I know.
ever again.
It's
So
too corporate.
yeah, it is. And you're kind of in control of your own destiny too. You're not a one-man band, but at the same time you're still in charge of what you got to do as far as putting loans together. You just don't have all the minutia in between stuff that you get cut out.
Welcome to another episode of Get Real Estate with Liz. And today I have a special guest and friend of mine, Mike Henson. And if you can introduce yourself, formally introduce yourself and tell us a little bit about what you do.
All right. Well, thanks for having me on. I'm really super excited to do this. I told you the other day how fun is this going to be?
Yeah.
My name is Mike Henson and I'm with Sage Lending Group. I'm a mortgage broker and I've been in the lending space 30 years. 30 years, a long time.
Almost as old as me.
Now I'm dating myself. Great. I've seen lots of changes over the years. I've lived through several markets that are up and down, refi markets, boom and bust. And this has been a tough one, this for sure. This year's been a tough one. But
for everybody.
Yeah, it is for everybody. But I wanted to comment on something about you. I've known you for last 5 years?
5 years, exactly.
Okay, when did you get your license? I was thinking about this on the way down here.
Exactly 5 years ago.
Okay, I've watched you grow your business for the last 5 years, and you have done such a good job.
Oh,
I mean, you have really blossomed into this awesome agent. You help a lot of families, and I'm so happy and proud of you.
Thank you. That means a lot to me. Thank you. I was not expecting that. I didn't pay him.
Didn't pay me for it, but it's true. You've done a really good job, and you help a lot of people. You've done really good with your social media, and now you've got a podcast.
Yeah. Thank you. Thank you to the man behind the scenes too.
Yeah, totally impressive. Got to do one for sure.
Yeah,
that's for sure.
Well, you mentioned right now broker. You're a mortgage broker. Can you tell us what the difference is between a broker and a regular bank?
Sure. So I've been in the retail mortgage space mostly my entire career. And a mortgage broker is different in the senses that we basically cut out the middleman. So whenever you work in a retail environment, you have investors, oftentimes you have a lot of overhead expenses. You have underwriting, you have processing, you have all these other things that management overrides and things like that cut into the real estate value or the profits of the mortgage company. When you're brokering, you don't have any of that. You're going directly to the investor. So what usually ends up happening is we get better pricing. We get the technology that we use with our broker investors is really, really good. And it makes things a lot faster. So I've been brokering now for a year and I love it. Love it. I don't think I'll go back to a retail environment.
I know.
Again.
It's too corporate.
Yeah, it is. And you're kind of in control of your own destiny too. You're not a one-man band, but at the same time you're still in charge of what you got to do as far as putting loans together. You just don't have all the minutia in between stuff that you get cut out. So that's the advantage of being a broker. So, good question.
And then also it gives you the opportunity to, deal with different banks, right? As well. So not necessarily they don't have to go shop around. You're like the one person.
Yeah, I can shop for them. Yeah. So we have a whole slew of investors that we have on our roster. And if one particular investor doesn't have a good price on that one, I can go to a different one. Or if they don't have a product or program that I need to get. So we can, as long as we keep them in our lineup, we have access to all of them. Retail environment is similar in that respect. They do have a lot of investors too, but it's the overlays of having all the overhead and all the other middle expenses,
like the processor and the underwriter and all that stuff.
Yeah, I still have processing. We can do remote processing if we wanted to, but we can charge a fee for that. But we don't have to carry all the overhead, and that's really the advantage. So we can pass along those savings back to the customer. The consumer is the one who wins in that. They're going to get a better rate, less fees, and it's better all around.
Deal. Yeah.
Yeah.
And then you mentioned, obviously this year's been a roller coaster and a big change for everyone, from the rates rising to dropping at the end of the year.
Yeah.
Can you give us like a little market update of what you think has happened,
Sure,
is
sure.
going to happen, and
Yeah. So we, early on in the year, there was several predictions that you probably heard it yourself, May 20th, we were going to have these, rates were going to start coming down. What nobody saw coming was that there were other expenses that were coming down the pipe with the administration. They put together a big bill, had to get passed, had to get funded. That pushed more of the inflation to the, back burner. So we ended up having a lot more inflationary things happen that delayed that, being at the peak of the mountain for the rates to start coming down. So we didn't hit it in the summertime. And we thought we were going to get it early fall, and that didn't happen early fall. We had other expenses that came out that caused inflation to stay in check. But we did start seeing that a lot of the measures and the reports that measure inflation start to show signs that it was getting to be an improvement.
mm-hmm.
The problem with inflationary data is the Federal Reserve, they look in the rear view mirror. They don't look ahead, because whatever they do causes what's called a lag effect.
Mm-hmm.
Okay, so even though we were seeing some inflationary data come out to be really good, start to show improvement, we weren't getting those rates to drop.
Mm-hmm.
Well, now that we've got enough data secured over the last several months, it's starting to, we're starting to see the cracks.
Mm-hmm.
And the Feds even came out the other day and just said, "Hey, look, I think we've done enough."
Yeah.
When really they did enough in the summer. We just needed to let it. They just needed to let it rest and let it ride out, because it takes a while for things to really happen. Mm-hmm. And so we're starting to see that happen now. So the last since October 18th or so, we really started on this path of having really a positive interest rate environment. We started, even though they weren't coming down a lot, they were coming down just a little bit every day,
mm-hmm.
just a little bit. And as we get, a month and a half into it, now we're out of those 8s
mm-hmm.
and 7s, and some cases we're in the high 6s. Just mm-hmm. depends on the product and the program and the loan. But I don't want to make any predictions, because we were so wrong out of all the predictions we made the other.
And then they're like, "You're a liar. You're a liar. You don't know what you're doing." Yeah.
But if you look at the national average rates right now, just below 7, I don't think it's going to end up being one of those deals where we're going to see rates come down really fast.
Mm-hmm.
They tend to go up a lot faster than they come down. So it could be possible by the time we get through the first quarter of this year, we could be in the 6s, lower 6s. I think that's my personal opinion. If this data we keep getting is favorable, mm-hmm. then I think that's where we're going to go. The Fed's cutting interest rates is probably not going to happen till late spring, early summer. But because they've talked about that, mm-hmm. the markets like that. The markets like that they're saying, "Hey, they're gonna be pausing now." So we're seeing those interest rates come down just a little bit more. Mm-hmm. So I think that's what we have to look forward to. I think we, traditionally, as mm-hmm. Wintertime is always one of the slowest times for mm-hmm. us, regardless of what's happening in the interest rate environment. So we're going to be treading through this January and February and March like we always do, mm-hmm. Just with a little bit better interest rate environment. And I think by the time we hit spring and those rates have come down enough, I think we're going to see sellers decide to start selling.
Yeah, again.
Yeah.
Well, usually the springtime is the best time when you start listing your property for sellers.
Sure.
And just, right before the summer, and it's like perfect timing right there. So with the rates going down.
Right. And I think the big message that we need to get out for everybody is, what's going to happen if rates continue to fall. All these people that have been sitting on the fence, waiting mm-hmm. for the market to crash, waiting for interest rates to drop, they've been waiting. Now they're all going to jump back in. Mm-hmm. So,
and that's what I was going to ask you next. What are your thoughts on that? Because right now everybody's like talking about that in social media, like buy right now, which I keep telling all my clients, the best time for buyers is to buy during the winter time, because you can negotiate the opportunity for closing costs, price reductions, or anything, because you don't have a lot of competition, regardless of whatever the market is. And and now with the rates going down a little bit, still take advantage. But now that the rates are, now that the prices are going to start going up, now you're going to have to compete with everybody else.
Correct.
So, there's a win-win situation on any.
Yeah. You should. Time. There's definitely a cost of waiting. We've mm-hmm. talked about that before. You can always renegotiate your interest rate. Mm-hmm. You can't renegotiate the price that you pay for the home.
Exactly.
So the education piece that we're trying to get out to everybody is the reason why you should do it now is because we're going to have so many more people entering the market when rates get a little better. That's going to drive prices up higher. Mm-hmm. So there's no benefit of doing that. You're going to lose.
And more competition.
You're going to have more competition. You're going to pay more for the home. you can always renegotiate your rate later.
Which means refinancing.
Refinancing, recasting.
For those people that don't know what negotiating your rate is.
Yeah, but the house is on sale right now, right?
Yeah.
So let's get it.
Yeah,
Let's get the house while it's on sale. But yeah, I think that's what we're going to see. We're going to see more people enter the market. Could be, going back to one of those scenarios that we had a couple of years ago where multiple offers and we're doing appraisal gaps and things like that. So
guaranteeing the difference if it doesn't appraise.
Right.
Like you said.
Right.
That's what he's talking about, the gap.
Yeah. Yeah. So,
we know, but
we got to explain it. Right. Exactly. Yeah. So it's, encourage everybody to, you need to make sure to get the process started now. I mean, it's not as difficult as a lot of people make it out to be. So I would say if you're thinking about buying a home, you really should get pre-approved right now. Let's figure out what you need to do to get that in place. So that way, when you do find a house, when you find them a house, you know what's going to happen when they find a house, they want it now, right?
Yeah.
So we need to be ready to go.
Yeah. Preparation. Be prepared for when the opportunity is there,
Correct.
You mentioned it's not that hard to get pre-approved. How fast and how soon can someone get approved?
We can get it done the same day, and we can get it done within hours if you got all your stuff together.
Exactly.
Yeah. So the process is basically we can do one of two things. I call it wet ice on wet ice. You know what that means?
No.
We got to make it as smooth and as fast as possible for you. So if you call and you want to get pre-approved, we can do one of two things. Skating? Like ice skating. There you go. We can take your application over the phone if that's what we need to do, or I can send a secure application link where you can fill it out online. It takes about 10 minutes, and you can securely upload all your loan documents. That comes straight to me, so that way when I take a look at it, I can review your income, your assets. I can review what you qualify for, pull a credit report, figure out what your debt to income ratios look like, and then we reverse engineer that sales price for you. We figure out what it is you need to do to get that particular home. And then, we also look at the affordability aspect of it. How comfortable are you with that payment? And maybe you qualify for that payment, but you're not really that comfortable for it, for paying that much. So reverse engineering and then just adjusting to what their comfort level is. And we can do it quickly.
And that's what I tell all my clients. Like, let's see what's your max loan amount that you qualify for. And then I always do the reverse engineering. Okay, so they do qualify for $1 million, but they don't want to go out there and spend $1 million. So where do you need to be at? Where are you comfortable at? But at least you're open to see opportunities, because you might limit yourself if you go backwards. Like, oh, can I qualify for this $400,000 house?
Right.
And then you might be able to see another house that's only $415,000, but you're limiting yourself because you think you only qualify for $400,000.
Sure.
So that's very important to see what's your max loan amount and then work backwards.
Correct.
From there.
And right now you can probably still get some seller incentives, which now we're talking strategy. So if the affordability is the issue, there are things that we can do to help with that affordability, especially if you've got some seller concessions. Like right now, I have a fantastic program where you can do a 1.0 buy down, which basically is a temporary 1% buy down for the first year. And if we can get the seller to pay for that, we also can get a free appraisal out of that too. And so if the rate was, and let's just pick one. If the rate was 6.5, your first year rate would be 5.5. So that helps that affordability gap.
And that's different from the 3-2-1 buy down.
That's different than the 3-2-1 buy down. Yeah.
So and we've talked about this before in the past, where there's a difference between a rate buy down for just, how can you actually buy the rate down for the whole term? Can you buy the rate for 1 year, or the 3-2-1? I mean, there's so many different programs. That's why it's important to talk to a loan officer, an expert that is in that field.
Yeah, there's temporary buy downs and there's permanent buy downs. So if we're looking at a permanent buy down, you don't get as much bang for your buck as far as a temporary buy down. You can really get it down either 1%, 2%, or 3%, depending upon how much cost is associated with doing that and if the seller is willing to pay it. I like the 1.0 buy down right now, because a 1.0 buy down is 1% for the first year. And we're likely going to be in an environment where rates are going to continue to fall. So we can get the benefit of having a lower rate. And then after that first year goes by, we'll see where it's at. As long as the equity position is there, we can't refinance. So that's another thing that I think a lot of people don't really talk about is there's no automatic you can refinance. So, you really have to have a strategy in place to figure out if that's what you want to do. And then that goes back to how comfortable the client is. I mean, what is their goal with this? Is this a long-term house for them?
Yeah, that's where I was going to say.
Yeah.
Because what's the point of you buying down the rate for 30 years and you're paying out of pocket up front, but it's not going to be beneficial because you're going to either sell or refinance in a couple years or 5 years
and you're going to roll all those refinance costs back into the new
loan. Yeah.
So there's no free lunch basically. So it's important that you're working with a lender that knows how to strategize these kind of things.
Yeah.
And we look at everything from their retirement goals to their college funding to are they moving? Could they are they going to be downsizing, or are they going to have a bigger family, need a bigger home? So we account for all that in the planning session of it. So hopefully, when we do close escrow on them and we keep up to date with them over the years, we're able to refer them back over to you because we've kept up with what their goals are going to be.
Or vice versa. Like if they reach out to me and, they want to pull money out because they want to invest, they can do a second or refinance or HELOC the opportunities are endless there.
Yeah. And I think what we're going to see too for a lot of people is, especially if rates continue to improve, I'm already getting a lot of questions on it, and that's debt consolidation. So even people who, right now we have the most equity we've ever had in our homes in America for the last 50 years.
Yeah.
So people have the equity, but we're also entering into that recessionary period where people have used, a lot of their savings. They're starting to use credit now because they haven't changed their lifestyle. So there's going to come a time where maybe a debt consolidation refinance is really going to be helpful for them. And I'm starting to get a lot more questions about that because they don't really have
and
the money
I know what that is, but can you explain to them? So basically paying off their debt into the refinance.
Student loans, credit cards, you name it, whatever debt that you have, solar, swimming pools, whatever you financed and are getting to the point now where perhaps maybe you're running out of funds for savings because inflation's high, right? Things are cost more. So we're getting more people ask about that. And one of the tools that I have at my disposal is a tool that does just that. It's a debt consolidation tool. I can plug in all your debts. I can plug in your current loan, look at what a new loan would look like, and see what that cost savings is going to be if we pay off all that debt. And strategize that. You still get the tax benefits of owning a home. And you might cash flow a lot better now because we got rid of the car payment, the student loans, and all those other things. So it's really about cash flow and getting people back to a position where they're more comfortable.
Yeah, with their monthly expenses.
Correct.
Because say I have a house loan and my mortgage is $3,000, and then a car payment it's $500, and then a credit card. I know the minimum payment's like $30, $50, but it adds up. And if you consolidate all of that, you might even get a lower payment or the same payment, or
without the debt,
without the rest of the monthly expenses. So
right, yeah, and there's there are arguments to be made. Well, I don't want to put all that back into a 30-year loan, but here's the deal: most people only keep a mortgage loan on average. Any idea? 9 years.
Yeah,
9 years. So something you have a 30-year loan, but most people only keep a loan for 9 years, and the reason for that is they either refinance, they move up, they sell. So average is about 9 years. And what people don't also understand about credit card debt, because right now with inflation, credit card rates are 25%.
Yeah, I've seen some higher than that. I'm like,
right, yeah.
And they're saying, oh, okay, well this one's only 8%, and I don't want to roll it over, but 25% versus 8%, right? That's a no-brainer.
Yeah, and most people will run a credit card up, and if they're heavy credit card users, it usually takes either a windfall of money or a cash out refinance to get rid of it because it's hard to come up with a whole chunk of money to do that. And at least cash out refinance to pay off debt is a vehicle that'll help solve that problem. So, and that's what we try to do, is help solve what their problems are. Because not everybody has enough cash laying around to say, oh, I'm just going to pay my credit card off because it's several $1,000s, or maybe they have multiple credit cards in addition to the student loan.
And they think that they're like, oh no, it's not a big deal, I'll just pay the minimum payment, but it keeps adding up, and they charge you more fees and late fee and this and that, and it accumulates. It's like, I don't know if you have ever, I'm sure you read the Rich Dad, Poor Dad book. There's a cash flow for money game, and it's like the rat race, and it's like kind of like the rats are spinning in the same circle. That's kind of the same thing with all your debt.
Yep.
You don't go anywhere.
Yeah.
So you need to get out of that.
Yeah, you're not moving it. So, yeah, so that's one of the things that we're going to be working on probably a lot more of this next year is really serving families with debt consolidation. It's not just about we do more than just purchase transactions. So, but yeah, really we just look at the whole picture and see how we can help and keep them up to date with what's current and what they need to do and refer them back over to you if they need to move. So yeah, that's what we do.
Yeah. No, that's great. That's great. So debt consolidation, and then obviously lines of credit or second loans. That's another option too. If they have like a super low rate, like the 2 or 3% that people were locked into, and they're afraid of refinancing because they don't want to mess that rate.
Yeah.
So there's other opportunities there as well.
Sure. There's home equity lines of credit, HELOCs, HELoans. We have access to those too. Just depends on what the use is, and we'll go into it with looking at would a second be better than a cash out refi? It just depends
because that's usually higher rates too, right?
Yes, they are. But the one thing that people don't understand, and I'll explain this in the best I can. So even though people got a home loan at 3%, 2.75% or 3.5% when rates were really, really low, they're carrying the 25% credit card, the 9% student loan, the 8.75% car loan, and all these different rates on things. They accumulate what we call a lifestyle rate. So yeah, your mortgage rate's at 3%, but your lifestyle rate is really 12%. That's what you're paying on. So if we can consolidate that, sure, it's probably going to mean you're going to have to give up a 3% mortgage rate. But if we can consolidate that and make your lifestyle rate more like 5%, you cash flow better, you still have tax advantages. It's just all around better for you as far as what you can spend money. And now that savings that you have, we can even do it one better. You can either take that savings and go buy other properties, take that savings and invest it, or you can take that same savings and pay off the principal of the new loan that we're getting and get you back down to a more equitable rate where you were before you left.
Right.
So there's different strategies that we can do.
The opportunities are endless, and that's a great point. I was just actually talking about that with somebody this morning about, because I do my follow up and I go door knocking, and are you interested in buying or selling? And then they're like, no, we're planning on never moving. But what about investing? You do have a lot of equity there. So there's once you start talking about, or at least opening up or planting that seed about, investing that equity that they have, and it's not just sitting there, it's working for you. It brings up, like a light bulb in them. So like he said, the opportunities are endless.
Yeah. You just got to explore them. Got to have a good agent.
And everything is better than paying 100% financing when you're renting.
Sure, exactly. Yeah, rent's 100%. Rate on that's 100%.
It's actually more than 100% because now it's 100% for rent, and then the 29% and all this other percentage for everything else.
Yeah, and there's been some really good changes with products and programs too to allow people to get into more investment type properties with a lot less down. So I don't know if you talked about it before, but Fannie came out with their new 5% down for investment purchase. If you live in a unit, especially if it's a multi-unit, FHA, we've had that same product for FHA forever.
Yeah,
3.5% down payment if it's a multi-unit property, a duplex or triplex or whatever. You live in one, you rent out the other two. It helps you in qualifying, covers your payment. It's a beautiful thing if you're looking to be an investor.
Yeah.
And a landlord.
Yeah.
So,
yeah, well, the FHA's always been there. The new one that just came out with the 5%. Yeah, we covered it on the last episode, but it is very important because people sometimes on the FHA, it has to be self-sufficient, and so we're limited on that here in the Central Coast just because the prices were too high. So when that opportunity came in, I was like, oh, it's perfect for everybody that's interested in actually going ahead and doing it. So thank you for reminding us about that. Yeah. Sure. Opportunities are there.
Yeah.
Anything that you can, give our viewers like a tip or incentive for them to start looking and investing in themselves in their future?
Yeah. So I ran some numbers before we got here. I was just curious on a couple of things. So one of the tools that I also have access to is what it's called the real estate report card. So I can actually pull any particular zip code that you want, and find out what the forecasted appreciation is going to look like, and that's factored in by CoreLogic. So it's taken some statistical data on the county and coming up with a forecast, which is a kind of a moving target. But what's interesting to me is that it goes back to the old adage that it's when's the best time to buy real estate? Yesterday. Right. So when I started pulling up all these forecasts, I'm looking at like Paso Robles. Paso Robles, the 5-year forecast is 26%. That's a little over 5% a year, and an average median price of $749,000. You're going to earn $200,000 in 5 years just for buying a house. Okay, so Pismo 29% over the next 5 years. Rio Grande 26%. San Luis Obispo County as a whole is 29%.
Wow.
So it's a long game. Okay, it's not about timing the market. I've said this 100 times. It's not about timing the market, waiting for rates to drop.
You're going to get rich tomorrow.
Yeah, it's not about timing the market. It's about time in the market.
Yeah.
So you want to make set
put
those
that
goals
ring
and
on
get
it.
Yeah, put the ring on it and get it, so you can make that $200,000 over the next 5 years, because that's wealth. That's how you build generational wealth is through real estate and waiting for it. Right? We got to have it, keep it. Let time go by, let that equity build, and then you can parlay that equity into a lot of other things. Recently, I was doing a Instagram video, and I've got to post it. I haven't done it yet, but I went back and looked at the first house I ever bought in 1994, and it's in Visalia. I paid $109,000 for the house in 1994, and my rate was 6 1/8, so it was relatively high for the time. And we just thought, how in the heck are we going to make a $900 house payment? I mean, literally, that was what it was, $900. And so, but we took that home. We lived there 10 years, and we parlayed that. We sold it, parlayed that equity into another home, parlayed that equity into another home, and we're probably 5 homes deep on that. And knowing what I know now, I probably should have kept that property, because what I bought it for $109,000. I pulled it up on I did an AVM on a Zillow thing, and it literally was $400,000. So from 1994 to now, it's gone up over $300,000 from what the initial purchase price was. So that's what I mean by long term, holding things long term, because that's where you're going to make money over time and build generational wealth. So if that's the tip, that's one tip I would say. And
that's true. I bought my first house when I was 18, and I bought it here down the street, 231 Chicory Lane. And I bought it for $143,000, and we sold it. I was married, I went through a divorce, so we sold it, and we sold it for $342,000. Yeah. And so we doubled it within a few years, just a few years. And now that same neighborhood is selling for over $500,000, right. $550,000, and I'm just like, wow, that's crazy.
Yeah. And I think the median sales price for here is what, $749,000,
yeah,
$750,000. So yeah, you got to get in the game. Yeah, you got to get in the game to win.
It's just getting like you said, locking it in, getting it in. And it's funny because we were just talking about that last week, and I was kind of giving an analogy to my clients that buying a house, a lot of the times people are just afraid to pull the trigger, and I was like, it's kind of like marriage. Like you're dating somebody and you live with them and you have that commitment, but you don't want to marry them because you're afraid of marriage. But in reality, it's just a piece of paper. Right. And it's the same thing with buying a house. They're already renting. Right. They're renting for we were talking about rents, $3,200 for a 2-bedroom apartment. The same responsibility is there, but they just haven't, nobody wants to pull the trigger to make that actual commitment of buying that house.
You're exactly right.
So I was talking, to my client last week when we went to go see a house in San Miguel, and he's like, I'm just afraid. I'm afraid of the commitment. I'm like, you're already making the payment.
Yeah. And you're not getting any tax benefits.
And you're not getting any tax benefits and not building equity. It's like your own personal bank account. So sure. We can give them the information, like they say, you could take the horse to the water. To the water, but you can't make them drink. Yeah. It's the same thing. But that's why it's very important for us, the experts in our market, to give statistics and let them know. That's very important. Just telling them those numbers. In 5 years, this is where you might be.
Right.
Obviously, nothing's guaranteed, but it's statistically based on the past, that's what you came up with.
Yeah. And I always tell everybody, if it's an issue of affordability, the one thing they have to look at is if I can qualify you for a mortgage, okay? If you qualify for a certain loan amount, you can afford it because we wouldn't lend it to you
Yeah,
if you couldn't afford
exactly.
it. The question becomes, do you really want to pay it? So we have to look at that too. So if it's a comfort level for some people,
Well, it's the lifestyle, like you
the
said.
lifestyle.
Sometimes we're so used to like traveling or going out and stuff like that, so we don't want to let go of that, and
Right.
that's why we kind of set our limits.
Mhm.
But you in paper you can afford it, right?
Right.
Because you
Yeah.
got pre-approved for
Right.
$1 million.
Maybe we just need to lower our standards just a little bit and get into the game with something.
Yeah, but not
Start
only that,
earning.
you mentioned about the buy down,
Uh-huh.
on the sellers, and I'm glad you brought that up because we're dealing with some sellers right now that are still kind of, I can't say for everybody, because
Right.
I tell my clients, every seller is different,
Sure.
right? So let's try. Let's offer less or closing costs or whatever. I can't guarantee because at the end of the day, it's the seller's decision.
Sure.
But there's still a lot of sellers out there that are holding tight and they're like, nope, they don't want to budge. They don't even want to budge on the price, or they don't want to budge on, closing costs or anything, which I get it. But I just want to remind my clients to not get discouraged. Maybe that's
Right.
not the one. Let's move on to the next one. There might be an opportunity on the next one. And the next one
Sure.
might give us a $10,000 discount and the closing costs. I mean, you
Right.
just never know.
Yeah. I think it depends on what the seller's willing to do. And I know, and just like, from the sales side, if a house is sitting there too long, it's probably overpriced.
Yeah.
And then there has to be, this conversation about, well, maybe we should reduce the price to get some more movement. And a lot of times what we can do on our side is say, well, hey, instead of just reducing that price, why don't you just pay for, give them some closing costs or pay for a buy down or something that will help incentivize them because it helps them have a more affordable payment. And it helps you, Mr. Seller, because you're going to get rid of your house at the price you want. Now, it might cost you a little bit in closing costs to do that, but it's a win-win. You're out, they can afford it, everybody wins. And so strategies, it's just all about
creative financing or
Right.
creative
Right.
offers.
Yeah, they're out
But
there.
just, I just wanted to throw that out there because I don't want people to get discouraged or like feel like, okay, this is what it is, because it's not. Everybody's different. Just the same with the buyers.
Right.
Not all buyers need down payment assistance. Not all buyers have the money. Not all buyers can afford the payment. So like their lifestyle, I would say.
Yeah.
So it's just working and trying to figure out what's best for everybody.
Yeah, and our job is to educate.
Yeah.
That's all we can do.
Facts.
We can lay it out there. We can educate you, and help people understand the whole affordability myth. I mean, because it really is a myth. You have to be able to have the right information to make informed decisions, and that's what we have to do. That's our job, is to lay it all out there, let you figure out if you can do it or not. Now, what I find is a lot of times people don't understand all the advantages. Like they don't understand that there's a tax benefit for it. So yeah, it might cost them a little bit more than rent, but they're going to realize a refund at the end of the year because of all this interest that they're going to write. A lot of people don't understand that.
Yeah.
So it's our job to really
Educate
them on that, because it can make a difference. Because you take that, you get a nice refund at the end of the year. That's going to help offset whatever cost that you increase your housing by. And now you're building something. You're building generational wealth. You're building equity. You've got a nice home that you can do something with and make money on. So, yeah, just educate. That's all we can do.
Yeah.
Help people the best we can.
I say that a lot of the times people don't understand because of the lack of knowledge or assuming just because the neighbor bought it and they think that they can fit exactly how get the same loan that the lender got or get the same price that the neighbor got or stuff like that. So it's just asking the right questions and to the right people.
Right. Yeah,
Very important.
Get them in front of us. Let's get in front of us. We'll get you figured out. That's what we do.
So ask us any questions, any concerns you guys want to know about. That's what we're here for. And how do they get a hold of you, Mike?
You can catch me on Instagram, Mike Henson Mortgage. I'm on Facebook under Mike Henson. You can reach me by cell phone, 559-909-2727. Or my email address is mike@sagelendinggroup.com.
There you go. So follow him on Instagram or Facebook, or reach out to him on his personal cell phone number. And you can always reach me on Instagram as well, or my cell phone, 805-286-6617. And please let me know what you guys think. Any questions that you guys want us to talk about in the near future, any concerns, reach out to us.
Perfect.
So, Mike, thank you for being
This was
here.
a blast.
Do you have a quote or anything special you want to just end with?
I don't know.
A joke?
Right now, my whole thing is let's go. I mean,
let's go. Get pre-approved.
Let's go. Let's go. It's going to get exciting.
Start the year.
Yeah. So good job.
Thank you.
Thank you for having me.
My pleasure.
All right.